Thank you for that very kind introduction. I got to meet some of you before, so if I didn't meet you before, just come say hi afterwards. This is going to be very just chill environment. We're just going to learn just kind of the basics. I'm not trying to say that I'm, the best investor in anything. This is kind of a basics course. If you're just getting into it, want to learn some things, maybe even just give you some places to find out what type of investing you like, so you can look into that even more. So again, my name is Silas Brooks, and we're here at Apex. Awesome place to be. Obviously, it's a beautiful facility. All your buyers, clients walk in, love the place. And then we'll have Defiance Capital, Jake Lasko here. We'll talk a little bit during the financing section. Defiance Capital's a great hard money lender I've used on a lot of projects. And thank you all for being here. I'm super excited to see a lot of familiar faces, some people I've never met before, and things like that. So we'll keep it fairly concise here. I will, at the end of this, if everyone leaves their email or contacts us with their email, I know some of you have given it to Shauna, we'll send all these slides out so that you guys can still have that information. We are doing a video also that we'll kind of post, because some of the stuff we'll talk about won't necessarily be exactly on the slides. So if you miss some notes, something like that, don't freak out. We'll get that sent out to everybody so you can just kind of have on hand. So a little bit about myself. I won't read this entire thing, but this is my beautiful wife, Avery, right here. We've been married 5 years. And then my little baby, Mila, she is about 18 months old. This is a little older picture. But this is my family. I just love them to death. We got another one on the way coming in October. We'll be like right at that 2-year mark and under. So pray for me. I'm going to try to keep doing this. I might just give it all up and let you guys take over investing while I'm just dad and at home, okay? So that might be what happens. A little bit about myself. I actually, real estate's my second career. I actually used to be a trauma nurse at St. Francis. I was a nurse about 6 years in ER settings. Went back, started working my doctorate of nursing, become a nurse practitioner. I'm like halfway through it and I realized, I don't want to do this for another 40 years. So then I'm like, well, I've always liked real estate. I'd kind of dabbled in it a little bit during that time. And so I had to make that call to my family, my wife, my family, be like, hey guys, I'm going to drop out of doctorate school. And everyone thought I was crazy. And I may be, I don't know, we'll see. Anyway, otherwise, I've been in real estate. Actually coming up, I was just thinking about this. I got out of school in 2014 from nursing. I got my license the first time in 2015. So I guess I'm like at 8-ish years now. Really been investing more, concentrate on that in the last probably 3 to 4 years or so. Yeah, it's basically about me. We like to travel a ton. My wife, I'd never traveled before at all until I met my wife, and she's nuts. She likes to bungee jump, skydive, all this stuff. I'm the videographer for her because I do not do that stuff. I'm not about to risk my life over that. So let's first talk about like why you're even here, like goals for investing. Why does anyone even want to learn how to invest? Like give me some reasons why this even comes to mind to come to this class. Anyone?
Finding rental properties.
Finding rental properties, but why do you want a rental property? What makes you say I want to manage tenants and find houses and all? Why do you want a rental property? What's your end goal from it? Yeah, some more income. And so really what all this stuff kind of comes down to is something like one of these things. You want your time back, or you want time in the future. You want to make some more money, and for most of us, money's not the main thing. Money is an exchange tool for other things in life. And so for us, money is usually going to lead to more time, freedom, security. Like most things in life are either a want or a fear type thing. You want to provide for your kids coming up. You want to provide for aging parents. You want security from that. You're fearful that you won't be able to do all the things in life that you need to do or want to do. So this is typically why people get into this side of real estate. 'Cause there's a lot of ways you can do things in real estate, but typically it really breaks down to this. For myself, the reason I got into real estate is I have parents that I love them to death. They've worked hard their entire life. But when it comes to retirement, I can foresee that this might be a little bit difficult time for them when they come to retirement, to be on a fixed income. Everything's getting more expensive. At that same time that my parents should be retiring and things like that are happening, I'm going to have kids that are going to be hitting high school, college age, and I have this lifestyle that I want to maintain while I help my parents make sure they have a good life and make sure my kids have all the things that they want. So for me, that's what this goal for investing really comes down to is security, like for our life and kind of that lifestyle. So there's a lot of ways you can invest in real estate, and I tried the best way to break this down to a couple sections we can go through, and the best way I could see to organize this is short-term and long-term investing. So that's kind of how we'll look at all the types of investing and break that down. So for short-term investing, the ones I have in this category are fix and flip, short-term and mid-term rentals, and wholesaling. And we'll kind of go a little bit more in depth in any of these. First off, does anyone here already invest? Does anyone already have properties, or what do you invest in already?
I have 4 rentals.
4 rentals, okay, great. All single family, okay, great.
I have some duplexes in my school.
Okay, great. When did you sell them? Last year, last couple of years? Yeah, we all sold them in the last couple of years. Those prices are nuts. I sold everything I had. I was like, because I told my wife, I was like, babe, like 5 years ago, I'm like, I want to start buying properties. Then last year came, I'm like, babe, I want to sell the properties. And she was like so confused. She's like, why did we just work this hard to buy all these properties? And now you're just going to sell them. But the last couple of years was great. We'll talk about kind of those times when it's good to sell and why you'd keep and why you'd sell, things like that. And then Monica, you raised your hand too. What do you have?
I have
5 rentals, great. Okay, single family, great, awesome. So going into this, the first short term we'll look at is fix and flips. And this is really, you're finding distressed properties or under market value properties, putting some money into them, doing renovations, and then at the end selling that for a profit. This is where I am doing the heaviest of investing right now. I guess I should told you guys a little bit about what I do for investing. So we had some rentals in the past, like we were talking about. We had 4 duplexes, managed 8 units, buy or sell, things like that. A lot of the things I'll tell you throughout this is because I made those mistakes. So I'm trying to help you guys not make those same mistakes so you can go a little bit further. I was listening to I'm a huge podcaster. I listen to this guy, Alex Hermosi, and he was talking about that, as mentors or teachers come into life, like what they should do is they should get you to their level faster and better. And so the goal of this is not to be like in 5 years that I'm way further than anyone else here. The goal is like, okay, let's all get to this level and then like let's move on, invest in bigger things together, stuff like that. So none of this is coming from like I'm way ahead of you. It's like, okay, I'm here. Here's the things that I've found that work better, not so good, things like that, so we can all get to those same points. So fix and flip is my main source of investing kind of at this time. Short term to midterm, this is kind of a newer-ish investing style that's, my terms may not match up exactly if you just went and Googled it to see what it is, but short term and midterm, we're going to talk about stuff that's maybe from 1 day to say a 6-month rental. So you're talking about Airbnbs, or another great midterm thing is like executive rentals and things like that, or travel nurses, travel doctors. Those are going to be like a span of like maybe 3 months, 6 months. Past that 6-month term, we're going to just kind of group that in with long-term rentals. It's just some different things we'll talk about later. Wholesaling, anyone ever done any wholesaling in here? Done some wholesaling back there, so that's great. So this is actually, I think, one of the most common ways that people get into real estate and investing, because a lot of times there's a lot less risk for that beginning person, but it has to be done right, and we'll talk about that. There's a lot of changes that have been coming up legislation-wise for this. But this process of you find a seller in a property, you get a contract on that, and then you're essentially selling your interest for that contract to an end buyer. So a lot of times you'll hear it called, selling papers, stuff like that. We'll talk about that more. So long term, it's going to be kind of that longer time span. We're going to take about like 6 months on is what we're going to think about in this type of investing. So buy and hold, simply buying a single family home, duplex, something like that, rent ready or near rent ready, put renters in it, make some money off that, hold it for a longer period of time.
Yes.
Yes. Exactly. Thank you for the validation on that. I love it. Just keep doing that. Every time I explain something, just hit me with a yes. Burr, if you guys, anyone listen to Bigger Pockets at all out here? So this is very common. This is like a very common term used in it. And it's something like, I feel like this is kind of popped up in probably the last 5 years as a term. I thought before that, people probably did it, but didn't necessarily call it this. So it's kind of the term we're using now to keep this all concise. So this is a process of buying a property, renovating that property, putting a tenant into it, refinancing that property to get your money back out of it, then keeping that property, keeping some cash flow, and then you're going to keep repeating that. So it's these are just short kind of versions of this, and then we'll go into all of it a little bit deeper further in the presentation. House hacking is another way a lot of people enter into investing. So you're going to use, typically people are using FHA loans, putting as small amount as they can down, like 3%, doing an FHA loan, buying a property and then either renting out rooms, or a fact that hopefully some of you know is you can purchase up to a quadplex with a regular FHA loan. So you can either live in one unit, rent the others out. I mean, if it's a duplex, 1 unit, if it's a triplex, 2 units, quadplex, 3 units you can rent out, and then hopefully pay for a portion or all of your hopefully mortgage expenses. So bonus ways to invest in real estate that aren't some of the ones we'll talk about today. REITs, it's kind of like investing into a stock, but it's all invested into real estate. So there's various ways it can be done. That's kind of the easiest way to explain it quickly. Syndications, where people get together, they might buy, say, a whole like strip center or strip mall, and then they'll bring people in with their cash, say $50,000 from this person, $50,000 from that person, get that down payment, get it funded, and then disperse things to them. So that's way people that can invest. If you have a large amount of money sitting around, you could just lend to people on their projects, get % return on that, get it back. Just being a money partner in a project, say I go to do a flip, someone can fund that down payment for me, so I don't have no money into it. They get a return on that money, and then I get to flip that, and everything that I make from it is just, complete returns, I'm not having to put any money down. And then if you want to create a fund, it's really similar to kind of the syndication, but you can pool money together and then buy assets with that. All that stuff, that's kind of more advanced. Gets into some things like SEC regulations and stuff like that, so it's probably not going to be your first step into real estate, but it's just something that we should know about for the future. So analysis, we're going to talk about how to analyze these different types of investments and to make them successful for you. And that's why we analyze. I jumped the gun there. But yeah, we want to analyze, we want to run our numbers to make sure that we know our money is going to be well taken care of during this investment. Real estate investing, you hear passive income like this, like it's kind of a fire word right now. Like, I want passive income. I don't want to have to, work. I want mailbox money. But realistically, real estate is a pretty active, type of investing. The thing is, you can make higher returns from it, but at the end of the day, those returns have to beat what you're making in the stock market or other stuff where you just sit money. You know what I mean? Like, you don't want to make the same returns when you're going out, checking on properties, tenants are calling you, managing contractors. Like, you can't make 7%. It just wouldn't be worth your time, because you could set that into a fund, and over time, without doing anything, you're going to probably make that also. So that's what we analyze. We want to beat other ways of returns soundly. So this is kind of very quick, just dirty fix and flip numbers. Typically, people will find the ARV, and ARV means after repair value. So you're going to go through, do a comp list, see what the house would go for in that area to the level that you're going to renovate it. So if it has granite, hardwood floors, beautifully repainted everywhere, islands, things like that, you're going to match what you would do to this property to what's out there, and that's how you're going to get your valuation on it, or your after repair value. From that, you're going to times it by 0.7, so you want to be at 70% of that after repair value. One thing how I'm kind of adjusting my analysis of fix and flips right now is, with this market, interest rates rising, the likelihood that you're going to pay some seller concessions, stuff like that, it's going up. It's more likely you're going to pay some closing costs, things like that. I don't think appraisers are being as aggressive as they have been, that's natural for a change like this. but I'm just being a little bit more cautious on those numbers. I'm not going to take that highest number I've seen, out there. I might take like, 5, 7, 9% off of that so that I can kind of adjust for where maybe the buyers aren't going to come in and pay that because interest rates have gone up, their payments have gone up. So you want to be just very cognizant of what type of market you're in, how things are going. So that's why I say this is just kind of a quick dirty math, but just adjust it to where the market's going to be at. And I'll show you some other calculators that can help you with that. So we're at 70%. So what's that 30% that we're starting off, taking off? That's going to be 15% for holding costs and 15% for profit. So when you go to fix and flip a house, when you're doing a flip, you're going to have your loan payments during that time, insurance, utilities. So I kind of group that all together under the holding costs. So that's 15% of it, and the other 15% is reserved for profit. Now you can work these numbers, and that's why I said it's not 100% how you analyze it. You can work some of those numbers because if you're flipping a 500K house, that 15% margin is going to be a lot more than if you're flipping a 150K house. So if you're saying, well, I can make this deal work, and instead of making 100K profit, I'm okay with making 80K, so I can up my offer a little bit. You can work with those numbers. So once we get to that 70% of the max of the ARV, we're going to take our repairs out of that too. So if your repairs are $25,000, you'll take that off. And that's going to leave you with the MAO, which is called the max allowable offer. This is a max you can pay for that house to make that profit margin you want to hit. And so we'll go through a couple of examples here. It's going to be a little bit hard to see here, but when I send this presentation out to everyone, you'll be able to see it a lot better. And I'll just tell you where these resources are at so you can use them. So this is actually on a Bigger Pockets analysis calculator. So once you guys get this, you'll be able to see, you put your purchase price in, you put your rehab cost in, it'll calculate some of your holding costs if you put in those terms in there. And from there, it'll spit out, what your profit will be. I think if you, total profit for this is $30,000, and it'll actually give you some hypotheticals and percent return on your money right here too. So this is really, I love this. I'm a big returns person. My mind works better looking at investments on the return side of it because I want to see, like, if I put 10,000 in, I make 20,000. Okay, 200% return. That gets me like really understanding that process a lot better. I like that part of it. So that's a Bigger Pockets one. Invest for More, spelled out FOUR. Invest for More has a couple good calculators. So I've personally built out a calculator in Excel for myself because I like to see certain things. I like to adjust those numbers really quickly. So that's something you can look in. There's probably way more programs out there, but I want to at least give you a couple resources to get you guys started to start looking at numbers. Short-term, mid-term rentals. These are a little bit different to calculate because there's a lot of X factors, and especially depending on where you're where you're buying at. A lot of people, like we've looked at short-term rentals like in Branson, Missouri, things like that. A lot of those are in condo communities, so you're going to have like different fees than you would otherwise. They're taking care of some of the outside maintenance, stuff like that. So simple terms on this, we're going to do our gross income. So what are you going to make total in from that property? Then you're going to take your expenses, you're going to subtract that, you'll get your net profit. So we'll do some example of expenses, your mortgage, taxes, that's your normal stuff. But short-term and mid-term, you're going to have cleaners, like toiletries, utilities. Like you have a long-term rental, typically you can have your renters do those utilities, so it's not coming into your expense sheet. But on these, you're going to keep that on. You're going to keep the utilities because you have to keep the lights on, so when someone checks in today, it's ready. So there's a couple different things there that you're going to look at expense-wise. Furnishing, that's a really big expense that if you're doing short-term, mid-term rentals that you're not going to have from long-term. So there's a few differences there. AirDNA is, I've used it mildly, so I can't say this is the best software for it, but it helps quite a bit. So I put in an address here of one that we were analyzing in Branson, and the annual revenue, it popped out like 35,000 on that. Told me a daily average and what my occupancy rate would be. When analyzing this, bless you, when analyzing these, those are some X factors that you need to be very aware of, and I would recommend finding someone that a property manager or someone that's in the game in that area, because you might think your daily rate's 200 there, but if they're saying no, typically it's going to be 160. That's a very big difference over 20 days out of the month over 12 months. That could change your cost and your profits quite a bit. So that's just one example of the softwares that I've used in the past. It'll even give you some comps for other houses in the area, so you can see, okay, is mine nicer than this? Is it not as nice as that? See what your daily rate's going to be. For buy and hold, there's a lot of really good calculators out there for this. Essentially, again, though, you're going to have your income minus all your expenses and get your net profit from there. But we'll run through some things a little bit more on that. This did not line up exactly, but this is one of my favorite ones, and it's actually on just calculator.net. It's a rental property cash flow calculator on calculator.net, and it actually encompasses a lot of features. I've paid for some in the past that didn't have as many as this, and it asks your down payment, your interest rate, the terms, the length of the terms of the loan, 30 years, closing costs. It even asks if you're going to do any repairs. Some of the things like you'll put in your property taxes, insurance, and then I'll show you on another one, but things that you need to really think about on long term, like the buy and hold, is your vacancy rate when you're going to have turnover. People sometimes forget to calculate that in, but I mean, you may have a make ready, so you're getting the house ready for your next rental. It might take 2 months depending on how bad like someone trashed that stuff, and depending on if you bought this with a tenant in it, there may be a lot of deferred maintenance you have to kind of bring up to speed. So that vacancy is definitely something you want to account for. And then again, just at minimum, even if you come in and get this house and it's back in perfect condition, you're still going to have some vacant times because you still have to get tenants in there, new potential tenants that you're screening. It's probably going to be a month process unless you just have someone that doesn't have a house that they're ready to go and you're ready to go, but it typically will take a little bit. So once you put all that information, it spits out down here your cash flow. If you can see that, $487 in cash flow a month on that particular analysis. So I just like this one because it also tells you your returns on this property. And then your net operating income, that's more of kind of a commercial type term, but this calculator is just really good. So calculator.net, I love that one. And then again, Invest for More has a really good one. It's super simple. It's a lot easier to visually see. You put your rent in there, interest, payments, things like that, and it'll spit out. What I like about this one also is at the bottom of the Invest for More rental cash flow calculator, it actually gives you some estimates on your maintenance holdback and your vacancy holdback on these, which is I think where sometimes people just don't think about that aspect of it. Like, you're going to have maintenance every year. If your house is brand new and you have someone living there that doesn't own that house, something's going to break, something's going to change. So you always want to have a holdback on that. And even if it shows your cash flow lower and it's not where you want it to be, just roll with it, put that in there, because you don't want to overestimate like what you're going to make on that property. And we'll talk some more about that. And then also gives you vacancy. So single family 5%, multifamily 10%, and then college rental they also have 10%. So you kind of put those two in there as holdbacks for that. BRRRR it's a very complicated thing to analyze, especially kind of talk to people about. So I'm making this as concise as I can, but it's kind of like a two-step process. You need to make sure that you're essentially flipping a property and then you're essentially turning it into a rental and then kind of refining that. So on the first side of it, you want to make sure that your purchase price and renovation costs are going to hit 80% of that after repair value. So what you think the top appraisal is going to be on it, or the top for yourself. And because what you're going to try to do is go back to a bank and then get them to give you a refinance on it, which typically on a single family is about 20%. That you can refi it out. So they want you to leave some equity into it. From there, after you've done that refinance, you still need to make sure it works as a rental. You still need to make sure you're going to make a little bit of money and that your expenses are going to be covered through that. So it's kind of a two-step process on that one. There are some really good BRRRR calculators out there. This one is actually the Invest for More BRRRR calculator, but I know I didn't have the Bigger Pockets one here, but I know Bigger Pockets has a super good one. They are huge on the BRRRR process, so they have one that's going to be very in depth for that. So, house hack. This is you're going to have the expenses kind of first of the mortgage, and then all the utilities and things like that. Then you may have a roommate or someone else in one of those units. So it's really going to be what your costs are, and then you take what you're getting from those. So if your mortgage is $1,000 and you're renting 2 of your rooms out for $500, then you've decreased $500 from your overhead that month. That's a pretty typical house hack. So the next stage of that is the financing stage. I think I actually missed one thing on the analysis. So when you first start analyzing properties, what you really should try to outline is a buy box. We call a buy box very typically in real estate world. And like, where do you want to buy at? What kind of properties do you want? Things like that, because what we want to try to do is take our emotion out of this. This is an investment. This is not like, oh my gosh, I love this Midtown house. It's like walking distance from my favorite restaurant. You can easily walk into a home and love it yourself. And what we need to do is we need to set our numbers, create this buy box, and then stick to that, because this stuff is not going to lie to you. Your percent return is not going to lie to you. And if we analyze this stuff correctly, that's really what you need to stay to, because even analyzing and when you go to flip a house, things like that, costs are going to come up. It's inevitable. There's something that's going to come up that's a little bit more than you expected, or the last couple of years products were more expensive than maybe they were the previous year, so you analyzed it yourself and then realized, oh my gosh, decking is now crazy higher, so that roof price went up astronomically if I had to redeck a roof, something like that. So but getting those buy boxes, and you may find like a section of Tulsa you want to buy in, and you might want to only do single family, and you might only want to do 3-bedroom, 2-bath, 2-car garage, because that's when you go. If you ever want to exit, like we sold the last couple of years, you want something that's going to sell easily. You don't really. I mean, you can, but I want something that hits the market. And it's like, this is going to fit like the biggest group of buyers, and so that's. Or you can have your own specific things, but that's how I like to do. I like to find something that when I throw this back on the market, it's gone. It's going to hit like the most amount of people, because if I ever need to exit, I want to know that I can exit like really well. So financing is the next thing. So we've analyzed this deal. You've kind of found it out there. You've talked to people, but how are you going to get the money? I think this is probably one of the main factors that keeps people from going into investing in real estate. Is they don't think they have enough money. They don't know where to get money. If I find a deal, what would I do? I'm not even going to look for deals because of that. So let's talk about kind of some of the ways that we can do that. So kind of the financing types we're going to talk about here is conventional or traditional ways of financing properties, hard money, lending, and then private money. So your traditional lending is going to be some of your traditional government programs like FHA, things like that. You can go to just specific local banks like Security Bank, Maybury Bank, and then also mortgage companies like AMC. There's a couple other ones around here that are just specifically mortgage lenders. So the issue that comes with some of these traditional lenders and banks, they do have, a lot of times they do have products where you can renovate a distressed property using RBEST or something like that. But it's just, that's not their main source. And so it's not as easy of a process to go through and do that. I never talk bad about anybody, so I won't say that there's anything bad about it. There are just other ways that you can probably get this done that's going to be a little bit easier for you, maybe a quicker transaction for you on things like that. Which that leads to hard money lending. And I'm going to introduce Jake Lasko here with Defiance Capital. And we've worked together on quite a few properties. And we'll talk about how I've used it in this, but I'll let you take it away.
A few of you in the audience I know, so thanks for showing up on my invite. It's always nice to have friends in the crowd. My background, I was a commercial banker. 14 years, US Bank. They put naming rights on a stadium in Minneapolis, but they didn't do a lot for my career, so I decided I needed to do something more. One of my former coworkers and friends gave me the opportunity and said, I invest in Tulsa. Tulsa investors are great, but Tulsa investors don't have a lot of options when it comes to how to fund their projects. If you go down to Tulsa with your experience in banking, I think we could do something big. So, took that opportunity, started this company in August of 2020, right after the pandemic. Actually had my very first kickoff meeting upstairs at this building. Apex invited us to speak at the RIA when Apex was, I guess RIA was small enough to still fit in Apex title. So, and from there we have just grown, and we've become known as just a trusted source of capital, a reliable source of capital. So, what I love to do, and this, I do have this as well I can send to you guys to look at. I can see why there's analysis paralysis when you have all these different ways to buy. Do you burr? Do you flip? Do you just buy and hold and just do a rate and term refi? Do you house hack? What do you, like, right off the bat, like, what do you do? So by the time you get to the financing, you might be a little tired and you're just like, I don't know what to do. I don't know where to go, as Silas mentioned. Banks are a great source. I mean, I worked for one for 14 years. I have nothing bad to say about the banking industry. But as an investor in the environment we're in, especially right now, their timing can be a little slow. And a lot of times they're limited on the kind of properties you guys can actually finance. Again, you go find a deal at the sheriff's sale, you go find a deal distressed or a wholesale deal that you need to have a light cash offer. A bank's not gonna be able to give you that light cash offer. Hard money, private money can give you that light cash offer. I can get you a pre-approval that says you are approved for funding up to X dollar amount on a purchase. You turn it in with your offer and you get elevated because you do have that cash offer. Because I close without appraisals, credit inspections, like it's an asset that you're buying that's interesting and the numbers make sense. And I kind of like helping people. That's why I like Silas, because Silas likes helping people. So this chart here, though, I like to look at it as like, as a new investor, where can you go? Because again, it's always good to think of all the opportunities in your universe. So we've got the bank, we've got the family and friends, and then you got Defiance capital or hard money or private money. And what are the pros and cons? And I already talked about the speed. Reliability, that's a big one. Because if you submit an offer and it's supposed to be a cash closing, and your funding source, if you go to Sweet Aunt May, and all of a sudden Sweet Aunt May needs the $50,000 she was supposed to give you for something else, you don't have your $50,000 to buy the house. When you use a private lender or hard money like Defiance, we are going to give you a pre-approval, and we're going to meet you at the closing table. I still am batting 1,000 at getting the closings on time. And if you call me, I don't want you to be the first example of that not happening. So I have a reputation to hold. Reliability is in our name as a company, and I want to continue to live up to that. When it comes to service, a lot of my investors do have really good relationships with a commercial banker of some sort. Some of them are business owners, so they've had a banker for years. Some of you guys may not. You may just be a retail customer to a bank, so you don't have that connection with a commercial lender. So they're not going to have kind of that first step to get maybe a preferred service on that first transaction. Family and friends, I don't know, it depends on how awkward you want Thanksgiving dinner to be. They may be really nice, but all of a sudden something happens and all of a sudden Thanksgiving dinner just got a whole lot weirder. Because now you can't look Sweet Aunt May in the eye and be like, it's so nice to see you because you didn't help me buy my first property. With service, I'm growing this company because we show up. I don't know if you have a really bad Oklahoma accent. Bad. Because I'm not from here. I'm not. I'm not a Tulsan. I do live in Colorado, full disclosure. But our company right now, 100% focused on Tulsa. This is where we're learning all of our best practices to be the best company we can be. And you guys just happen to be the lucky, yeah. You're my test pool here to see how it goes. So I will be following up with you quickly. I think best example, I had a guy call me, had an address, and literally you give me an address, you text me an address, I'll look at it, we'll kind of run some quick numbers. All of the way Silas was talking to you guys about how to analyze, I did the same thing. I was able to give a guy an answer in 15 minutes. Now, to the inverse, if it's a tougher deal, again, I want to be the guy to kind of help you realize that this is a business transaction. As Silas said, this is not for you. And if it's not going to make money for you, and it's not going to make enough money for you, then why are we even talking about it? And sometimes as a new investor, that's really hard because you're emotional. Like, I want to start this, and I want to get into investing, so I want to buy this house. But the margins, like, maybe you're going to make 10 grand, maybe, on a lot of risk, on a lot of time. And Silas and I did a podcast, and I talked about at some point, the next level of thinking as an investor is, if I'm going to do this full time, how much money do I want to pay myself for the pain and suffering of going through and becoming an investor? Either working with a GC or self-subbing it out for yourself and working with a network you have. There's got to be a number in there to make sense to you, and there's a number in there to make sense to me for you. Because I have really good, thoughtful conversations with everybody I work with, because I want to know the goal. Some people were burrs that have moved to fix and flip this year. Some have been fix and flip that are moving to burr. Because they want to try it out, right? There's all these different ways to do things. The approval process, I think I just mentioned, pretty easy when you work with a hard money lender. And again, my favorite quote from one of the podcasts I watch is, if you work with a lender like Defiance Capital, if I'm not making your life easy, you can go find somebody else who can. So I better darn well show up and make your life easier. On the appraisal part, again, no appraisal. We'll have a discussion about ARV. Let's talk about comps. Let's talk about what's going on. Maybe you're a realtor and you can pull your own comps. Maybe you and I are just going to have a discussion about Zillow and what we're seeing with recent sales in the area. On the down payment side, this is where private money and hard money can be your friend. Because A, we're not necessarily going to have a seasoning period. We don't need you to have 15 deals under your belt. I will work with new investors, and I will hold your hand, and we will walk down the road and figure out how to do a deal together. I do need, at a minimum, about 10% down. Because this is a loan. This is not a joint venture. I'm not just going to give you all the money and get an interest rate and then get paid back. Like, I want you to be invested in this property like I'm going to be invested in this property. Now, what I will tell you, next level thinking that we try to do is, once that 10% is in or once that 15% is in, and then you start rolling and you start finding more properties, and you're like, well, how do I buy the next one? I don't have any more cash. I gave Defiance Capital the 10% I had to buy my first house. Well, hey, if you're done with that first project, let's just roll your equity into the next one. And now you're into the next deal 0% down, because we just rolled the equity from the current project you're in into the next deal. And now we're on a roll. Now you've got the momentum, you've got a partner in lending behind you that's going to help you get to the next deal and the next deal, and all of a sudden your portfolio is going to grow. Borrowing limits. Right now, we kind of try to keep each individual borrower kind of around 5 to 6 loans at a time. And that's typically right around $500,000 to $600,000, just with kind of the normal Tulsa size deals. Right now, I do have 63 properties that I've financed around Tulsa. Some of them are multi-packs, and I've got stuff in Claremore. I do North Tulsa. I got stuff in Coweta. I got stuff in Sapulpa, like anywhere in the metro. And we're starting to branch out. Oklahoma City will become a thing. We're going to let the economy kind of do its thing and kind of settle down. Because the housing market has hit a certain spot in most of the country. Now, what I love about Oklahoma, it feels like Oklahoma still has room to grow because people are still moving around. And they're finding Oklahoma as a safe haven because of cost of living and access to things that they want. Construction funding, an important part of this, right? You're going to buy a house that might have some holes in the wall, and it might have some really ugly mirrors and some ugly fixtures from the 1960s that we probably want to update. I fund 100% of your rehab. And when we have a phone conversation, I'll talk more about the draw process. But I will tell you that my draw process is very easy, and I'm actually going to be getting some new technology to make it even easier. I fund next day. So you get me a draw by about, say, 4 or 5 o'clock Central Time, you'll have money in your account the next morning. Unless you're submitting a draw for, let's say, you want me to pay for the paint, but we haven't even framed the walls. Like, I'm not going to pay for your paint if we haven't framed the walls. Flexibility and creativity. Again, I go back to that past conversation on your down payment, how we can roll your down payment equity into the next deal and the next deal. With hard money, private money, work with somebody that can be creative with you. Again, there's a gazillion different ways to be an investor. So why can't your funder be there with you to come up with a zillion different ways to help you buy the next property? Now, this is where a lot of people go, but you're really expensive. And to that I say, yes. But the value is the ease. I'm a big time value of money guy. And if you're sitting around waiting for a bank approval for an extra 4 weeks, well, how much time did you just miss in the market with your house being ready to get onto the market? Paying me 12.5-ish% for a 6-month term loan means you're really only paying me 6% interest. And I'm doing all these things to make your life really easy. Because you're not putting in a bunch of tax returns. You're not waiting for an appraisal. You're not waiting for the credit committee on Wednesday to hopefully get to your loan that week. I'll get you an answer. You'll know that you can either go or no go, and we go. And we close as fast as the title work is ready. Now, we do require title insurance. That's why we're here, because Shauna's like, yeah, title insurance. But we do, because sometimes when you're buying these distressed properties, there is some weird stuff that can go on. I'm in the middle of one right now. The guy's trying to buy a really cool little triplex on South Carson, right south of downtown. But there's some minor owners and some major owners, and some of them are in assisted care, and we need different signatures. But then there's somebody who died that now can't sign, so now we need a quiet title. And you don't want to take on that as a new investor and all of a sudden have all this title work blow up at the closing table that you can't sell that or you can't refi out of my money. Because look, I'm not cheap. I do not want you in my money for any longer than you have to be. I want to help you get to that success point, because if I help you get to that success point, that means I get to do the next deal with you, because we had a good experience. And I'm proud of the fact that investors like Silas, I got a couple there, Susan and Eric are here, that we've done multiple deals with. My biggest client, I've done 11 loans with my biggest client so far in 2 years, almost 3 years. So I've built that trust with those people, and I want to do the same thing for you guys, because as a new investor, it's so scary. There's so many things out there. On the funding side, I want to make that part feel easy and actually attainable. Now, we still got to find a house, which is what Silas can talk about. But again, timing is critical. One asset class we do lend on is sheriff sales, which is a little unusual, because sheriff sales are a little unusual. Anyone ever gone to the Tulsa County auction? Now, it's been a little tricky the last 18 months, because there's a lot of hedge funds and out-of-state investors that send their reps to the auction, and they pay way too much money. Way too much money. But as other markets recede, that money is going to go back to the bigger markets again. It's going to go back to the Miamis and the LAs. And also in Tulsa, we'll have more opportunity for the investors like you guys. Sheriff sales are just weird because we're buying a house together sight unseen. We can't go into it. We don't know what problems there are with it. We kind of just have to hope that everything's okay. And there's the whole process. You got to put 10% down, and you got to pay the rest of the balance with the confirmation. There's a lot going on. We can talk through that. If you go to a sheriff sale and you find some properties that are interesting, because the list comes out ahead of time, you're like, well, shoot, that house looks interesting. I should at least go try to buy it. Let's have a conversation about it, and let's see what we can do. So again, that's my favorite is I had a prospective client reach out to me and say, hey, could you help me? And I said, I think we're overpaying. So she went and got funding from somebody else for the share sale. Well, then they said, well, this is a share sale. We can't close it. So she came back to me, and we're giving her a bridge loan for her to get to her bridge loan so that they can get the title work ready.
I have a really strange random question. So is there a way for you to pull past claims on a property that's up for sheriff's sale so you can see if there's been any major losses on that property? Is that a possibility, or is that just kind of up to?
I mean, the only thing we do is I'll work with the title company to kind of just pull a title search of some sort just to see if there's any other liens aside from the stuff that might get cleaned up. But yeah, I don't look for.
Insurance claims, like maybe they had a major water loss, maybe they had a major.
I have not found a way to figure that part out yet.
Okay.
Okay, that'd be good. I like ideas. So I'm going to stop there. Any questions about hard money in terms of how it could fit into your goals and how you get there? Happy to answer anything.
How would you work in a money partner to cover the 10% down?
Mm-hmm.
And do you need their financials or any information from the money partner? How do you work with that?
So the short answer is no, because you guys are going to have your own agreement of what you're going to do. I'm more concerned about just making sure we have what we need to get to the closing table. I will ask for proof of the liquidity, that we know it's there, that it's somewhere. But no, I mean, that is common a lot of times. I mean, Silas talked about that with kind of ways you can fund is you get a money partner, and that's okay. Again, you can mix family and friends money in with my money. That's fine. Cool. Anybody else? Yeah, these are just private money deals. They're bridge loans, less than 12 months. So, it's really more just building the trust. Because again, when you start a company like this, there's a lot of, I think, preconceived notion of what hard money can be and what a lot of people's experience has been with hard money. I mean, there are sharks out there who change the loan terms on you right at the closing table. They increase the fee right at the closing table. And so there's this reputation that we have as an industry that we're very focused on ourselves. And there is a group of private lenders like Defiance Capital, we're trying to change that perception that we're truly just a tool that works with the client to help them get to goals. And that there's nothing shady or nothing weird that's going to happen with your transaction. Well, Silas, thank you for the invite to come be the special guest. Appreciate your guys' time listening to me.
I've got some notes if you want to plug that back.
Yeah, I got you.
Some notes just as I was listening. So thanks to when you're listening to that presentation, stuff I just want to point out. Hard money is a part of your team. Really all your lenders and contractors, stuff like that. This is extension of your business. It's not in-house, but when I go to Jake, like I want his opinion on that property. Like you said, if he comes up to you and says he sees more deals a year than you're going to see in probably 5 years. So he has a very good touch on the market. We go to the REIT meetings and stuff like that, and there are a lot of investors doing a lot of properties in Tulsa, and Jake works with a lot of them. So if he's telling me a property's, he's like, man, this looks a little slim from what I'm seeing. Like I trust his opinion because I'm here to make money. He's here to make money and make his business work. But in order for his business to work, it means that my money has to be right and my money has to work too. So they're part of your team. They're not, if they come back and question something, like don't get your pride up there like, well, I found this one, this is great. Like think, oh, okay, well if his business is run off loaning money. So if he can loan money, he needs to loan money. But if it doesn't make sense and they're coming to you, there's a reason why that's popping up. But again, also, my next thing is just mindset. Like relationships in everything is huge. This game is even bigger than most things you'll do because we want to have a good relationship and knowing that he can come to me and tell me, hey man, I've seen someone else flip something just like this 2 blocks over. This is what it just sold for. Like you're getting real live comps that you may not even find yet from someone that's working this market he's talking about title work and things like that. And since we're at Apex, I'll share with you guys a story, one of my title things that came up. I purchased a property, got full owner's policy, title work, all that. A lot of people, you can get past this and you can do like quick claim titles, quiet titles, stuff like that, just to get the property a lot quicker. I always do full title work. And I didn't know why I always did it. I was just like, well, this is just what I think is the most proper way to do it. I knew people that bought, their regular homes get it. It finally worked out with my benefit. 2 weeks ago, I was going to sell a property that I just purchased from the title company like 3 months earlier. When I go to sell, they found a $10,000 tax lien on it that wasn't before. So I get an email like, hey, in order to sell this, you got to cough up $10,000. I'm like, oh my goodness. That's crazy. So I'm thinking about it. I'm like, I get on a Friday at like 5 p.m. So obviously my whole weekend's shot. I'm just like, my kids running around with a little toy. I'm like, not now, baby, not now. I got $10,000. We gotta, But so end of the story. I had full owner's title policy on it. I call them like, hey, we did this in the beginning. I think it's like what, $250, maybe $350, something like that. Well, that being said, since I had that policy, and you guys know there's a back end like company that has like, that does a lot of this stuff. Well, it ended up being like First American Title on the back end that ran all of that, and they pulled it and missed it the first time. And when I go to sell, they find it now because this person had used like 50 different names naturally. But anyway, they find this and realize that they just missed it on the first end, on the back end side of it, and they let me close. They paid for that. I closed the property, and they're going to take care of finding that person for the money. So that's the importance of that stuff. And I think when you get started out, there's some expenses like that you might say you're penny pinching, and you're like, oh, I'm gonna cut that to the side. But that stuff, like, you have to cover yourself, because a bad kind of start to your career like that may set you back for a while longer. So just kind of be cautious of some of that stuff. On that topic, something I've heard before is, don't miss quarters picking up pennies. So there you can save $250 or whatever, but then at the end of this, you'd have been a world of hurt if you had to do 10,000. Like at that point, you're like, if you're profiting 25 on it, you're like, man, is this worth my time over 4 months for that amount? So that's one thing on the title work. Relationships are just absolutely huge. Like having your insurance company, your title company that you can call and ask questions to, your lenders that you can call, ask questions to. You don't need to worry about it being an expert in all those areas. You need to find experts and build relationships with them so you can come to them, because there's going to be a question that pops up that they're probably going to have to look up. So you can't expect yourself to know enough in those areas to do that. Something I want to hit on again for hard money, and the reason we're giving this such a good amount of time is because hard money is, I think, a huge key to scaling investing. Yes, you could use all of your own money and maybe buy, maybe a $50,000 property and then scrounge for the reno or whatever, but at that same time, you could split that and you might be able to buy 2 properties and have some extra money as hold and get your rehab funded, and now you're just really pushing along. Like to scale, you're going to hear leverage a lot in real estate, a really big factor in this. But I want to point on, keep in mind when you see these percentages that they're annualized, like he's talking about. So if you're only holding this for 6 months, you're only paying 6 months of that annualized. You're not doing that full percent. Another thing to keep in mind when you hear that 10% down, realize it's probably going to be a distressed property. So that 10% down is probably going to be like, 10% of 60, 70, 80, maybe $100,000. So if you have an ARV of, 200, 250, like just keep in mind that 10% down to start with, you're going to be in that lower value, and you're getting so much from that. And I want to hit again, the draw process is easy. That's where some of this stuff comes in when you're working with other traditional styles of lending and things like that. They don't know you, they don't have a relationship with you, they don't trust you type thing. So that process, I've done it before, and it's like your contractor wants a check for whatever, $5,000 for the flooring because they just finished it. And you're like, okay, well, hold on, let me get a draw. And then you go to your bank, and the bank says, okay, well, we'll send an inspector out, maybe sometime in the next 10 days. You're like, 10 days? My contractor wants $5K right now. 10 days comes, they get their pictures, they send them back to the bank, 5 days processing of that, and you're just like, that holds your timelines up massively. And so if you can get that draw the next day, pay your contractor and move on to the next thing. And so I always like to have some money set back that I can pay those contractors, send that receipt and pictures to Jake, get my draw the next day, that money's back to me. I can keep moving, because this is a game we're trying to beat the clock also, because every day that you have it longer, you're spending more money. So just kind of keep that stuff in mind. Those draw processes going quick means that your rehab's going quicker, means you get that sold faster, and you save some money on that end. So yeah, we pretty much went all over this. The final last little thing I want to talk about, let me see, we'll push through this last section, but think about hard money. It's really kind of an asset-backed lending strategy versus, like, they're not looking at you. Like when a regular bank wants to see your credit, your bank history, your tax returns, they're trying to say, is Silas gonna actually pay this back? Do we have confidence that he's going to pay this? It's a good investment for us. When hard money is looking at this stuff, they're really looking at that asset. Like, are you buying this at the right amount that if something were to happen in default, like, it's still profitable on that end? So keep that kind of in mind on lending purposes. Private money, he talked a little bit about this, but this is really when you're gonna find friends, family, someone else that has a lot of money, go to them directly, get money to fund investments. This is something that you really need to know what you're doing so you can kind of walk them through the process. They're going to have questions on how long is it going to take, have you done this before, what's my returns going to be, and you need to know what a reasonable return is, things like that. You need to know how to structure this. So it's definitely out there. This is probably going to be one of the more complicated routes, just because when he gives me money, we talk when we need to talk. If someone else is giving you their life savings, they're going to want to be in that property. They're going to want to know stuff. So it can get like you see. I think you on it said it's rough when family and friends give you money. Yeah. So next, okay, we know how to finance. Oh, I hit that. We know how to finance these properties. We're kind of thinking about the strategy that we want to do in real estate. How are we actually going to find properties? So we're going to run through this pretty quick, but this is really kind of your bread and butter. You're going to hear it a lot of times, this term or this phrase that you make money when you buy the property. And in a sense, that's kind of true, because you just need to stick to those numbers and see those profit margins that you have and kind of stick to that. Just analyze that stuff really well. So acquisitions, this is where I talk about buy box. So when you're acquiring, you want to, so I have area, purchase price, after repair value kind of range. So I really like to, I'll kind of tell you a little bit about mine. I like a lot of places in Tulsa in the suburbs, your Owassos, Glenpools, Bixby, Broken Arrow, Jinx. I like to stay under 300, and we just did one that I went over 300, and it's a little hard to get those sold and moved, especially with interest rates going up. So that's why you want to hit these boxes, and that's why I'm telling you to do what I didn't do, because I'm experiencing, even when I talk about this stuff, profit, cash flow, and size of properties. So your first acquisitions piece is just network your behind off. You want to meet everyone you can in the investing world, everyone you can that does construction, wholesalers, real estate agents, investors, anyone out there. Like, if you're talking to someone, talk to people about real estate. Real estate is the easiest thing to talk about in the world. Have you ever met someone that talks about real estate and they didn't want to talk about it? Like, if someone finds out you're a real estate agent or an investor or something like that, they always want to be like, well, how's the market? Well, how's this? People love it. Like, almost everyone has thought about flipping a house from HGTV. They thought about having rentals. So just get out there and talk with people. This is the cheapest way to get real estate deals. Other ways we're going to talk about, you're going to pay. You're going to spend money to acquire deals. Networking and talking with people, that's going to be your cheapest route of acquiring deals. Cold calling, this is a very popular way for people to acquire deals. This is really, a lot of this is done usually by wholesalers. Now, people can set up outside cold calling things by themselves, but a lot of people that you're going to find doing a wholesale kind of process like this is within some type of wholesale company. And the way that most of them do this is they go to sources like ListSource, PropStream, Privy, things like that, and pull records of people that have properties. And you're going to niche these lists down to someone that has, like, say, high equity, owned the house maybe at least 10 years or so, some things like that. Maybe someone that there's a lien on it, or a vacant property, a rental property. And so they pull these lists. You'll get like, you'll say you'll pull a zip code. You might get, 5,000 like names or something on that. Then you're going to skip trace those names, which gives you the phone numbers for all these places. And then they put them into these dialers, and they're like multi-line dialers. They can dial like 4 to 10 numbers at the same time. They're trying to get as many people as they can talk to. If you guys have ever had a text message or a call that says, hey, you're interested in buying your house, there's someone with a big operation behind the scenes doing something like that. All of that information then goes into like a CRM, so they can follow up with you and track who they talked to, who they haven't talked to. And most of the time, these are callers are usually virtual assistants from kind of all over the world. There's people that have call centers set up everywhere, and they pay them to call a certain amount of time or a certain amount of hours per week to find these. So that's kind of your cold calling setups. Biggest piece to everything we're going to talk about acquisitions is your follow-up. You just got to keep following up and even if you think, okay, if every one of us went out here and did this exact same thing, someone's going to answer on Wednesday at 5 p.m. and then they may never answer that phone call for the next 30 days and vice versa. They may not answer for 30 days, but one day they had a doctor's appointment at 2 p.m. and you call them that exact time that they're out of work. So just don't get discouraged when you think that there's other people out there doing this stuff, because it's a numbers game really. And this all is a business and comes down to numbers and the amount that you put out. Driving for dollars is another very popular way to go about this. It's very simple. It's a pretty low cost. So you just drive around neighborhoods looking for distressed properties. Maybe they have really high grass, boarded windows, peeling really bad paint, things like that. Just something like we can all point out a distressed property, if you see that. There's some apps like PropStream and Deal Machine you can have just on your phone. If you see that, you can mark that property right there, and then you can skip trace it, try to call that person. I've actually done this before. I bought a duplex like this. I bought a duplex on a street, and then I just called everyone in that neighborhood and found another guy on the same street with a duplex that wanted to sell. So I bought this one duplex for $150. It immediately appraised for $170 when we purchased it. I called this guy down the street. He's like, don't you ever call me again unless you're gonna pay me $125. I'm like, I will meet you today. Like, where do you? I'm like, you know what? You drive a hard bargain, sir, but I'm gonna do it. So. Found that one. That's one of the ones we end up selling later on. And so, my cost for that, is probably skip traced it. It's like $50 a month for DealStream. I skip traced it for like maybe 15 cents or something like that. So when you're talking about like deal costs. Again, all this stuff is going to go into your CRM. You're going to follow up with this stuff. If they don't answer, that just means you got to try again. Advertising. This kind of gets into a lot of ad spend, and it's something that you're usually going to find some other ways first to really get your business cranking before you start spending this kind of money, because it can get very expensive. Facebook, Instagram, Snapchat, YouTube ads, all really. They're decent paid stuff. Probably the most successful way on ads on this stuff that I've seen in other organizations, wholesale industries, Google pay-per-click. So Google puts up ads, and you don't pay Google unless someone clicks on your site. So you're not spending money unless you're getting impressions, which is better. Facebook just throws it out there, everyone sees it, and you're paying X amount for it. So you're only paying Google when they're driving traffic to your site. They have to visit your site, click on your site. And so they're at least getting an impression of it. Radio, TV, streaming, billboards. To me, these are all accessory stuff. I think you have to have a pretty good, well-machined kind of business, because how many times have you realistically called someone off a billboard? Probably not much, especially this day and age, but you are getting a visual sense. So if they see your billboard, if you're like Erin right here, is she still there? No, she was right there. Erin Catrone was right there. So you're like, it's brand recognition. And so then when they get a postcard to their house from you about it, oh, I know this person, because you work with people you know. You're not gonna just pick up, if you know me and then and some other realtor approaches you, you're most likely to work with me. And that's the same thing with your brand and in your business is brand awareness on that. Don't cut out MLS, okay? This is there's a lot of stuff MLS is where deals go to die, but there's people out there that they don't understand real estate investing, they don't have a desire to do it. There's realtors out there that are just posting properties. You're like, this is a phenomenal property. So don't cut it out. Set yourself up an MLS search for if you want to be like, say 80,000 under. You can set up a box on there for those you guys have MLS, or if you don't, if you have a realtor you're connected with, have them set you up a search, and just be quick. Be the first there. Have your hard money partner ready, and you're writing offers that can close very quickly. So you're in a really good spot. So don't cut them out, because there's still deals that come to market from there. You'll see these all the time. You guys seen these signs sitting around corners? We buy houses. They're called bandit signs. And you typically set them up in the areas. People buy tons of them and set them out everywhere, and someone will call, say, hey, inherited a house that's distressed and want to sell it. Mailers this is a strategy people have been using forever. Postcards, mailers, brochures into targeted neighborhoods. You typically, when you think about this stuff, when you're doing acquisitions, you're not going to be like in Yorktown trying to be like, hey, you want to sell your house for cash real quick? No, you're not, because think about those numbers we had to hit before. You're talking about like 55, 60, 65% of that end value. So you need some type of motivation. This is not your everyday, just average seller there's someone that's like, hey, I'm getting the heck out of Dodge. I want my money. I want to leave. I don't want to deal with this. Some of these properties can't go traditional lending. Even when those lenders won't lend to you traditionally on these properties because they're distressed, they're not going to lend to anyone on those properties because they're distressed. So you have to have working. I had a house that was in perfect condition. The only thing that was wrong is they pulled up some nasty carpet in one bedroom. That loan wouldn't go. It wouldn't pass because there was exposed concrete, and that's not that bad. But traditional lending would not pass it until they put something on there. So think about that. There's some situations even that just won't pass traditional lending that makes it a better candidate for something like this, an as-is buyer. Some of the mailers that I've used Ballport Marketing before. It's pretty good. It's those handwritten letters, if you've ever seen those. They have a machine that actually looks like handwritten stuff, and very expensive. The handwritten ones are expensive. You can do postcards for a lot cheaper. The rate of response from the handwritten ones are much better. People at least open it, and opening is getting a view. So that's really good. And all the acquisition stuff really comes down to a numbers game. If you're going to do ad spend, if you're going to do mailers, if you're going to do any of that stuff, it's a game of I'm going to spend this much. You're going to track that and see how much you get in return. Then you can increase that spend and try to track some of that profit from it. Just regular old canvassing, door knocking, hangers, flyers. I like to do this after I've sold a property in a neighborhood that may be distressed, putting hangers, flyers out like, hey, I just sold this property for X amount. And that way they'll say, oh, that's interesting. You either get a listing, you might get a listing from it, you might get another distressed property that's in a very similar shape, kind of things like that. I just thought about this, I didn't add it on here, but Craigslist and Facebook, Facebook Marketplace, you'd be surprised. We got a really great deal at 27th and Sheridan off Facebook Marketplace, and they had a listed price. The listed price made sense for the numbers, and we bought it, and it went really good. So keep your eye on that stuff. If you're going to be on Facebook, I know you guys are on Facebook scrolling stuff. Just hop into that little sales tab and look at houses and just set yourself up a little search for that. Management of these properties, we're just about done, guys. I won't keep you all day, but I'm an over-explainer. If I tell you about something, I can't just be like, okay, and that thing, and I'm just done. I'm a talker, and I want to make sure that I give you at least a decent enough information. This is not the end-all be-all investment slide. This is a place for you to start so you can continue researching in whatever area you find the best. And education is going to be your biggest asset in any of this. Just keep learning. So short-term rentals, we'll just go through these quick things to think about when you're managing these properties. You're gonna have a lot of bookings. If you're doing an Airbnb and you're in a hot area, bookings are gonna come in, questions are gonna come in, things like that. So just be prepared if you're doing something like that. It's a lot more time in with that property than your traditional buy and hold. You gotta stock products, the cleanings. We had some Airbnbs, and the biggest thing that we ran into was if you have 5 units of Airbnbs and usually there's 1 to 2 cleanings a day. Okay, you got, one cleaner, maybe a second cleaner you can come in and ask, but maybe you get to 10 Airbnbs and one day you have 10 turnovers. How do you go from that one cleaner to cleaning 10 houses in that time allotment. So those are just things to think about when you're scaling an Airbnb business, short-term stuff like that. Maintenance, contractors, utilities, and then the daily rate adjustment. That's really huge. You can't be priced too high on a weekend nothing's going on in Tulsa. Like, they're not just coming here to get some sushi, you know, so you gotta think about that. Also, if Justin Bieber's in town, the ladies are gonna pay a lot for Justin Bieber, so you can up your rates and make some more profit there. Long-term things you gotta really watch, tenant screenings. You're gonna have someone in this house for a long amount of time. Like, you need to know that that person's not gonna trash your house or run a drug operation like I've had in my house before, where I walk up and they've turned the whole garage into a grow op, and I'm like, okay, this is very interesting. They posted everywhere like, do not knock like you're the police. Some over there like, hello, it's just me, not the police. Maintenance, and if you're doing like something like the BRRRR, like the refinances, you have to make sure, like, this is where going back to analyzing, you have to make sure if you're counting on pulling that money out to move on to the next one, you got to know your numbers are right, because if that refi doesn't work out and you don't get to pull your money out, there's all your money. How are you going to move on? It stops you up. And rent collection, one of the hardest things about long-term rentals. Just some extra tips here. So you're working with contractors. I'm going to give you all the, from my view, the book, answer, right stuff for working with people. Okay. So when you're working with stuff, license, I never waver like on that. If you need electric, plumbing, anything licensed, get that stuff done, because if that ever comes back on you, you can say, hey, I use a licensed contractor over here. Like, God forbid a fire happens at a house that you have renters at or Airbnb and someone's injured. Are you gonna wanna pull up that receipt for an unknown person they can never track? You don't want that. You don't want that on you. Do the right thing and pay them a little bit extra money, because you're gonna run after people no matter if they're charging you this or that. It doesn't really change your management of them that much, but at least gives you, they're insured. So licensed, insured, or bonded, you hear that term a lot. You want a W-9 for them if you're paying money, so you can turn that into your CPA that you've spent that money on it, so that it doesn't just look like it's all profit. If you can't prove that you spent that money, it's gonna look like profit for you. Get contracts. If a contractor's coming in to do this, and that, get a contract that said they're gonna do this, and that on these dates, given a period of time for that to be completed. And this is the payment structure I like to do. Sometimes people ask you to do deposits down. I like to do 25% to start with, 50% at the halfway mark, and then 25% hold, so that way you know that stuff is done. Because when you give them that full payment and there's 3 things left to do, it's gonna take you 60 days to get 3 things done, because they're already making more money going on. That's just how it is. I understand it, but you have to cover yourself. And after you get into it, you'll know that there's nothing, I'm not saying anything bad about any contractor. This is just like how business works. They need to make the most money to keep their business running. And once they've got that mostly completed, it doesn't make as much sense to move on to another big project. So they kind of move on. After a while, you'll get to know your contractors. You need to set up a team of them that you know. I can give you a door code and you just go to town and I don't have to worry about you. I'll come check on it every couple of days. I can leave material. I've got great contractors. Had very bad contractors at times that I did all the mistakes you start off with. Like, well, I need to make some more profit, so I'm gonna go over here, save $500. Turns into issues, lose $2,000. Should have just used the other guy, you know. So it's not. You got to find the right mix of all that, like where it makes sense for your business, but you don't have to worry about stuff. The contractor we have now, like, he's had. I can't even imagine how many like hundreds of K of material on site. Never had one single thing go missing. Not a doorknob, hinge, nothing. Not with this guy. Other person, I don't know where all the stuff went, but finances. I'm just gonna give you this is just beginning tips. Like I said, this is a beginner's course, just things to be thinking about. Like, as you start running your business, like, look at this as a business. We talk about this as investing. That term goes around a ton, but a lot of this is really active business, like dealings. You're not really just, to me, investing is like, put that money over here, it makes money, I get some returns. This stuff is, you're talking to people day in and day out. You're checking on material, you're ordering material, you're running a business. Don't get yourself fooled that you don't have to. Actually, I'm gonna call out Erin right here. Erin is actually, she's my transaction coordinator and is doing bookkeeping for me on this stuff, because I just realized I was not that organized in that section, and I needed to bring in people that are like, I realized about myself, I was not going to get to the level that I needed to be, because that's just not, I'm a ball of energy. I'm always running around, and I'm like, okay, there's a pile of receipts right there, a pile of receipts right there. I'm gonna get those later, and I'd never get them. So I need to find better resources to do that. So get that stuff going. We're tracking with QuickBooks right now. We set up a bank account that's completely separate. Always, if you guys are in real estate as realtors and stuff like that, so you already know not to commingle your money and stuff like that. But if you're not in any of that, never, ever, ever mix any of your funds. Like, set you a separate bank account, fund it, write the checks out, say business funding on it, memo, put it into your own separate business account under your own separate LLC at this bank. Like, I got in trouble because I had it in the same bank, and I got my debit card mixed up one time, and I'm just swiping. I got little kitty floaty toys on the business account. That's not good, not good. That was way back in the back when I wasn't doing things properly. So get your separate accounts, get that stuff set up really well. Do not mix your funds. It'll also make it easier for you when you go to track and do your taxes at the end, because everything from this account is strictly from my business. Also, other stuff, CPAs will guide you on this. I'm not a CPA, I'm not giving any advice like that. But if you start mixing funds, it can, what they call a corporate veil. It can pierce that corporate veil and then open you up to liability from your business side. So if you've mixed those funds and someone falls and tries to sue you from this house, and they see you've just been commingling your money, that pulls them into all your personal stuff. So just make sure you keep that stuff separate, okay? We've got to protect ourselves. Get credit eventually. You can get like business Amex cards, business Chase cards. I put a lot of my like rehab, like stuff I'm buying stuff at Lowe's, big purchases from Amazon, put it all on there. I'm going to use that cash anyway. Immediately pay it through that, and then I just get the points for it. So might get 1.5%, 2% back to use that, however. And then Lowe's, Home Depot, a lot of places you're going to use, you can probably get a contractor's account there. Lowe's has a really great thing. It used to be called a LAR, but I think it's like a LCA now is what it's called. And they'll run your credit one time and give you an account. And it's basically like you can get like $30,000, and you can put everything on that, and you don't have to pay it for 90 days. So if you time your rehabs right, your refinances and your sales correctly, you might be pretty close to getting that thing paid off. Yeah, my brain, I'm so ADD. I gotta throw this in. If you rehab a house too fast, there's a 90-day hold on that if you sell to an FHA buyer. So you need to make sure if you're rehabbing it that quickly that you look and make sure that it's either not the regular traditional FHA buyer, or you just need to just recognize your timelines, because that can hold you up. If you're like tomorrow I'm getting paid, and they're like, no you're not, because you flipped that way too quick, and you never think about flipping it too quick or doing something too quick as being a negative. Insurance, I'm going to touch on this really quick because I think that people underinsure themselves. I'm not an insurance agent and other stuff. I just want to give you guys as much as I can and how I think this can be done the best to cover you, because we would rather make small steps forward than big leaps forward and massive fallbacks at the same time. So regular homeowners insurance on your properties. If you're doing a rental property, I really like to try to find a insurance company that will do full replacement cost value on the roof. That's probably going to be one of your bigger expenses that can come up. And there's actual cash value or depreciated costs of roofs, and then there's some that will actually do the full current cost of that roof. So I always do homeowners insurance on it. Builder's risk is, I think, one that people skip a lot when they're flipping houses, but this is like a lot of coverage for your materials and things like that. If they're driving with your granite and countertops or whatever, some of your vehicles, and it all falls off and breaks, builder's risk is going to pick up like that. Someone comes in and hits, or excuse me, like just tears up your house, something like that, builder's risk is going to take in some of that. I actually need to go back 1 second right here to, okay, the workers' comp or exemption for contractors. I had a buddy that owned a roofing company, and one of the subcontracted people fell off a roof, broke their back, and he was actually able to sue my buddy's company, it's like parent company, because that crew and that company didn't actually hold a proper workers' comp. And if he didn't have like coverage for people not covering workers' comp, which is confusing, he would have been like probably out $2 million or something on that. So people can be exempt from workers' comp, but that only covers one person. So they have to be like a sole owner doing the work themselves. Otherwise, you need to make sure if you're having a crew out there that they have something like that, or you need to recognize that risk, one of the two. I mean, you guys can make all these decisions yourself, but I just want you guys to know some things like that. Title insurance, we talked about that, how I got in that kind of situation with title. So just, I would do it just because that $250 is nothing in comparison. The lien that came up on mine was $10,000, but it could have easily been $30,000, and that would have eaten a lot of profit. Blanket umbrella policies, this is something that kind of covers you generally. So like if you were to comment and post a bad review when someone tries to sue you for defamation of character or something like that, this is something that could have some coverage for you throughout that. Also, people getting hurt, that workers' comp, it's kind of a blanket policy to help you from a lot of types of litigation, stuff like that. The one thing that comes to my mind is as we post flips, as we post rental properties, as we post all of our activities, you know how the world's crazy. They're just like flat out. So people could target you and be like, oh, well, they see that we're selling a property at X place, like who knows what could happen. They might, oh, I was walking by your place and fell and hurt myself. So we have to cover ourselves throughout all this. And then if you're doing any type of construction, have that kind of company, you need some like general liability for yourself also. I'm just gonna throw these up there. There's different ways you can structure your business. I'm not gonna go into that super hard because it needs to be really like your CPA and that works with you on that. But you can partner with people like we were talking about, like the money partner. You might be able to do something like that. It might look like just like creating LLC together and putting that money in and them having ownership of that amount. There's a lot of ways you can structure this stuff. Joint ventures could be two LLCs coming together and partner on a flip or something like that. I've had successful partnerships before. I love it, it's great because you can bring in people that have skills that you don't have, so it makes your business better. At the same time, you really need to know that person because you have a lot, like everything is together on that. Like you need to know that person really well. And I would venture to say it's more important that you're aligned as a person and like your values and how you're gonna conduct business, really than some of the other ways, because you're gonna have some tough decisions to make and you need to, it's like a marriage, it truly is. Like you have to communicate really well and be on that same path. I think that's pretty much it. Yeah, that's really pretty much it. Yeah. Sorry. I hope I didn't babble too long, but I want to give you guys a good kind of detailed structure of how to get into this. Again, it's just a baseline, get you guys started, get you some resources and topics on that stuff. And does anyone have any questions about anything? Yes. Yeah.
For you and also for Jay.
Yeah.
What is your favorite source of information for comps for Tulsa?
For comps, so I'm a realtor, so I use MLS. That's my main route. What's your favorite comp? How do you guys do comps?
Mixture of a system called PropStream.
Mm-hmm. Yeah.
And then I'll just do a base Zillow just to look at a neighborhood, kind of see what's been going on lately.
Yeah.
But I do not look at the Zillow
Zestimate. Yeah.
That's bananas.
Yeah. Sold stuff. I see people comping and like people will send me comps based off of like what's listed. That listed, it can be listed there and it might be right, but that does not mean what it's going to sell at. So look at what's sold, and then take an account for what the market's doing. Is there 10 houses in there at that same price and nothing's moved in 30 days? The market tells you. Like if you're priced too high, I've been priced too. I'm aggressive, investor at times. I've priced my stuff too high. And I sit there and I'm like, if it's, the first one I was like, I called him like, man, I'm not getting any action. I'm too high. I'm 2 weeks. If I haven't got much action, you're wrong. That's okay. That's just part of it. You're just wrong. The market will tell you. If you get 50 showings in the first hour, you're probably too low. Yeah.
I just wanted to add about like the ARV when you're dealing with wholesalers.
Yeah.
Their information they post is not necessarily accurate.
Yes.
They'll say ARV.
Yes.
Repairs. You got to do your own research.
Yeah, you do. And it's some of them might be not trying to be truthful, but a lot of them they might not know. They might just be going in there too. And yeah, and they're like, oh, that roof, that'd be fine. But we know that roof is never going to pass an appraisal, inspection, appraisal, stuff like that. So, get out there. If you're not comfortable with rehabs, start looking to come out and see people's rehabs, ask them their numbers, get with a contractor you trust, get a bid. Like you would rather do that and get more comfortable with things. Get a couple bids. When you're first starting out, get a few, 2 or 3 bids from people, start getting to know who you can trust, get referrals from people. The Tulsa real estate investor group is great. I mean, you get in that group, go to the meetings. There's great people. Referrals are great. And never fails, a referral does not treat that person the way they treat you for some reason, but get some referrals going on, yeah. So prop stream's a good one if you guys are not licensed. Prop stream's good. And then, did you ever use Privy? We met over that. Is it okay?
I've been using for that.
Okay. Privy's another one that's been coming up more recently. That's a good one that just shows you a lot of data. If you're not a licensed realtor, just go to a realtor. They're you're a realtor? Okay, yeah. So we have, realtors here. I see a couple other. They can be a good. Don't use them, abuse them. If you're not going to use them, don't send them a bunch of comps. That's annoying AF. And then they're gonna be like, nah, I'm never working with you. Be respectful of their time. It's a relationship, a partnership like anything else in this. If you I always tell people, I look, no matter who, I look at you as a customer of mine. I want you to be happy. If you're happy, my life's better. If my realtor's happy, my life is better because they know I'm not sending them 50 things to comp and they've never bought one property. Now, if you're trying to get learning, just have an understanding with them. Hey, let me buy you coffee every time. Let me send you a gift card after 10, 15 that you do. Build that relationship, because if you're using, abusing them and someone else is buying after 10 comps and using them, then they're probably going to put their time over here. They're not going to send you those properties because it does take time. And also, I'm an agent, but I pay agents exactly what I would make. I never cut that stuff. Again, that thing, don't miss quarters over pennies. I want every transaction to be like, that is a good dude. I want to work with him. He's not cutting commissions anywhere, stuff like that. So.